Good afternoon. My name is Tony Bancroft. I'm the Aerospace and Defense Environmental Services Analyst here at Gabelli. I'd like to now introduce our next company, Graham. Representing Graham today virtually, this is CEO Dan Thoren, COO Matt Malone, and CFO Chris Tome. Graham's based in Batavia, New York. It operates in the energy, defense, and industrial industries. The company has 11 million shares, trades around $35 for a $400 million market cap, and $30 million of net cash. Gentlemen, can you hear me?
Yes.
Yes, we can.
Great. Awesome. Well, Dan, Matt, and Chris, thank you for being here today. Looks like you've had a pretty good year. Stock's up 40%. Maybe you could give us a brief introduction, sort of a high-level overview of Graham, your core businesses, key markets you serve, and what differentiates you in these markets.
Yeah, I'd be happy to. Thank you, Tony. We have a presentation, hopefully, that can come up on the screen. Thank you, and good afternoon, everybody. I am really sorry we could not be there today. I personally really enjoy the intimate setting and the structure of the Gabelli conferences. So kind of bummed we can't be there, but that said, Matt, Chris, and I are very excited to tell you about our company. Before we begin, I think slide 2 shows the safe harbor. So I want to point out that we may make some forward-looking statements during the presentation and the following Q&A. And those statements are covered under the safe harbor that's provided on this slide. Slide 3 gives an overview of our company. So Graham supplies critical equipment for defense, space, energy, and process industries. The equipment that we design and manufacture and service are vacuum, heat transfer, and turbo machinery. So these look like steam jet ejectors, big heat exchangers, shell and tube type heat exchangers. And then turbo machinery we talk about as pumps, turbines, compressors. These products are used in refineries, petrochemical plants, Navy ships, submarines. We get into thermal management systems on radar and lasers, electronic pods on aircraft, fuel cells, power plants, spacecraft of all kinds. So a wide variety of systems as well as markets. As a corporate entity, our mission is to build better companies to deliver superior performance. Our people are engaged and invested. Our culture is built on creativity, continuous improvement, and teamwork. And our structure provides deep strategic and operational support and shared services. When we talk about process, we talk about organic and inorganic elements. As Tony started to introduce our stock and performance, you see some of the stock specifics down in that bottom table. You can see that we have engineering and manufacturing locations in New York and Colorado and Florida. We have a sales office in Texas. We have sales and project management offices in India and China. Next slide. As Tony alluded to, and probably folks that have come to the Gabelli conference here for the last several years know, we've had an amazing journey over the last 4 years. Historically, Graham served the refinery and petrochemical markets, suffered through those cycles that come with energy. In the 20-teens, Graham pursued defense to begin to diversify their business. In fiscal 2021, our revenue pie is shown there on the left. At the beginning of fiscal 22, Graham acquired Barber-Nichols to accelerate that revenue diversification. And then over the next 4 years, our revenue picture changed significantly. We doubled in revenue, as you can see. And we shifted our revenue to a more stable mix, with the majority coming from defense with long-term contracts. You can see on the left-hand side that petrochem and refining were 2/3 of our business. Today, they're closer to 1/3 of our business. Next slide. Earlier this month, we announced a leadership transition that we believe will strengthen our corporate team and enable further growth. I'm going to step back from day to day and we'll be focusing on strategy and pursuing opportunities that will feed our business for the next 10 years. Matt Malone, who has been running Barber-Nichols very successfully the last 4 years, has been named President and COO. In June, he will become the CEO and is expected to be appointed to the board of directors. Mike Dixon takes over general management of Barber-Nichols, and John Painter, our current board chair, will become lead independent director in June when I become executive chairman. Matt and I have worked together for 10 years, and I have extreme confidence in his leadership and business management capabilities. I'm sure that Tony will want to ask us a question here a little bit deeper, and we can go into that between Matt and I. I'll wrap up with the next slide, which is it shows the 5-year plan we developed and communicated in fiscal 2022. We said 5 years later, by 2027, we wanted to be over $200 million in revenue and hitting the low to mid-teens EBITDA kind of profitability. Our strategic initiatives are shown at the top of the slide. So full life cycle mission critical products. That full life cycle kind of means you start with the design, and you know, starting with the design basically allows you to continue to renew yourself. And then you end with aftermarket, so kind of the full life cycle. The aftermarkets were really where we had the high profit revenue tail. Secondly, we work hard on operational excellence to improve performance and competitiveness. We talk about getting better, a little bit better every day. Continual improvement is a topic that is bandied around quite a bit in our companies. Third, we're investing in growth prudently, as you can see with the ROIC. And then the fourth item is we're going to, and we have been engaging with key stakeholders, our internal and external teams, to help us grow and get stronger. The bottom part of the slide shows our progress since fiscal 2021, and then our modeled performance going forward to 2027. You'll notice the gross profit improvement comes a little bit slower. What we're doing is we're investing in our businesses to make sure that we can grow sustainably. And then the profit really comes along a little bit faster due to the leverage we get from that revenue growth. Ultimately, the secret is, you know, this controlled, steady growth with investments that make our business sustainable and profitable. So, Tony, that's kind of a high-level overview of our company and where we've been, where we're going, and we'd love to answer any questions that you or the audience may have.
Thank you, Dan. That was wonderful. And again, thank you, Dan, Chris, and Matt, for your leadership. Company's done great. Maybe with that, we could dive in to the rest of the business. And you are right, I'm going to ask, and I might as well get the grill out of the way here. But earlier this month, you know, you did outline the two-phase leadership transition. Maybe you could just walk through more depth why you did it then, and does it signal anything else?
Yeah, great to have the opportunity to talk through that. 4 years when I became CEO, the board asked me, Dan, how long do you want to serve? And I said, I'm thinking 4 years. So 2 years into it, they said, are you still on the 4-year path? And I said, absolutely. And so we got really busy, you know, putting a development plan together for Matt. So we've been working with Matt on, gosh, everything from, you know, board meetings to investor meetings to getting more and more depth in all of the companies. And he's come along really, really well. So it was a very well planned, orchestrated development effort for Matt. And honestly, Matt's superpower is being able to lead people, engage people, and really get the most out of them. We've done quite a bit of work on our companies, preparing them, stabilizing to begin with, really getting the continual improvement piece in place. And now we're talking about growth, more frequently than we have been in the past. And so I get to move to a little bit more of the growth side, the strategic, the biz dev side that I love. I love connecting inside to outside, really talking to customers and understanding strategically where the company needs to grow. And Matt has shown, over the last 4 years that he runs a company really, really well. And so I'm really excited for him to now take responsibility for the entire company and lead it forward. Ultimately, we end up with a much stronger corporate management team. Matt, you want to add to that at all?
Yeah, I think the only ads that I would have, Dan, is we've done this transition before. When Dan went to lead Graham, there was a lot of support needed in that business unit. So Dan was spending about 80% of his time there, which left me to lead Barber-Nichols pretty exclusively, which has been a very successful journey. The nice thing is myself, Chris, and Dan have been the ones developing the strategy over the last 4 years. And so I get to carry the momentum forward, but have been intimately involved. The nice thing is when you have an insider move forward is you have continuity in the business plan. So business as usual, we have an awesome plan and we're going to continue to execute it.
That's great, Dan and Matt. And Matt, congratulations again, as well as you, Dan. Maybe let's move to revenue diversification. You had it on the slide. The mix shift of revenue has been pretty dramatic since 2021. Maybe you can go a little more depth about what enabled this shift and how, thankfully so and rightfully so, has impacted the broader opportunity set.
Yeah, absolutely. So the biggest impact, obviously, was the acquisition of Barber-Nichols. It was transformational. It really gave Graham Corporation a nice piece of existing defense business. And so that was probably the biggest impact. But as we kind of look at it going forward, one of the things that you have to do is really execute well, make sure that your customers are satisfied to be able to retain that business. And we've been working very, very hard, especially on the defense side, to make sure that our Navy customers are very happy with what we're doing and the quality and the schedule associated with their programs. So we've had a lot of success there to the point where our customers are investing in us through these supplier development funds. Boy, that kind of is a great feedback loop that says, okay, you're doing pretty well, keep it up. That's been the biggest change, just from a revenue mix standpoint. But what we really haven't talked about in that slide is the synergies that we're starting to get from our three companies that we have at this point, where we're all helping each other out with some of the best practices, and maybe I'll hand it to Matt to describe some of the engineering impact that we've had kind of across the companies.
Yeah, and Dan, I think you alluded that quite well. So while the defense sector is becoming quite important as a stable mean, both in terms of revenue and backlog, it's opening up a lot of opportunity to continue to extract value and I would say ride the peaks of the energy and chemical sector. And so we're really seeing opportunity to bring the innovative businesses between Barber-Nichols and the recent acquisition of P3 to bolster the install base of the energy and chemical business. So an example that Dan alluded to is we're actually using P3, which mostly works on advanced space, and they're actually using computational fluid dynamics to improve the performance of our legacy install base on the commercial side. And so we're really starting to see where those small tangents overlap. If you look at a Venn diagram between business units, and so we've got the value creation side with Barber-Nichols and P3, and then we have the value extraction side with Graham. So I think we're really starting to nurture with very little effort how that can grow into a really successful playbook.
Very nice. And what kind of defense analyst would I be if I didn't ask the Doge question on digging deeper into the Navy opportunity, in terms of future revenue based on planning shipbuilding programs, which pretty much lines up very well with what you're doing. How does Doge, the Trump administration, and those 17 exclusion areas that looks like you're pretty well set in, help you out with defense opportunities?
Yeah, Tony. So I'll answer that. To date, Doge has not had an impact on the corporation, and the reason being is, we're positioned on some of the most strategic naval nuclear programs. They're set in stone for quite some time out. With that being said, we are still very closely monitoring what those impacts could look like. On the Virginia class, Columbia class, and Ford carrier, we still have an active pipeline with, future perspectives on all of it. And so it's progressing well, almost unchanged. Where we start to see both a risk and an opportunity becomes on those longer, more wild idea type programs, which is more where Barber-Nichols gets involved. And those are the not must-haves. We don't have any impact today from Doge and others, but we're sort of looking at it actually as an opportunity. And an example of that is the propulsion equipment that we use on our torpedo platforms, for example, is directly usable on autonomous vehicles underwater. And so we're actually seeing the potential opportunity where it flips from an efficiency standpoint to actually, further growth. And so we would be normal providers on the strategic naval nuclear as well as opportunistic disruptors on the programs that get more emphasis. With that being said, the last thing I will say is we are a very small, nimble corporation, and we have innovation. And when you combine those two things together, we do align to actually greater efficiency with contracting processes. And so we think that we'll be able to pivot quickly and align with the upcoming, efficiency changes. So no impact to date, and we're continuing to monitor it.
That's great. Thanks, Matt. Maybe switching to petchems, what opportunities are you finding in the petchem refining markets? And are you able to, use your R&D to expand your growth, sort of like you mentioned previously?
Yeah, so twofold answer to this. The first is we're seeing a bolstering of aftermarket growth in the U.S., specifically, across the U.S. market. With that being said, the one thing that we're not seeing is capital growth and reinvestment in terms of new equipment. With $1 billion of install base, that's giving us a lot of opportunity to extract value in our existing install. And then we're bringing modernized equipment like we just announced with the next generation nozzle. What that allows the factories or the facilities to do is get more production with the same assets that they have today. So we're enabling either savings in cost and or increased production with the same facility. The number twofold answer to it is we're seeing a lot of potential growth internationally. And so we're taking a local for local strategy. So China serving China, India serving India, and we're aggressively pursuing that strategy as we move forward, both from a cost and competitive advantage side. So I would say that the two responses would be domestic aftermarket through innovation and international to serve rest of world in these emerging markets.
Very nice, Matt. Moving to margin expansion, you discussed it briefly with a slide. You've done a nice job, obviously, expanding gross margins from 21% to 25%, with the target reaching into the mid to highs. 20s by 2027. What specific initiatives are you driving this improvement, and how sustainable are these margins going forward?
Yeah, I could take that one, Tony. So as you stated, and as Dan stated on his slide, right? 3 years ago, we set out some financial goals and targets for us for fiscal year 2027, a 5-year plan, which called for 8 to 10% organic revenue growth, as well as getting to the low to mid EBITDA margins. Well, to get to the low to mid EBITDA margins, it would require us to get our gross margins up to the mid to high 20s, which is what we outlined on that slide. At the midpoint of our guidance for the current year, it's calling for 24.5% EBITDA gross margins. And we reiterated that guidance at the end of last quarter. But so we still have some work to do, and that's mainly going to come from a multifaceted approach, right? One is that obviously with higher volumes is going to become higher leverage and improved margins, right? So just naturally, as we have higher volumes, we'll leverage our fixed overhead. Second of all, we're getting better pricing, right? So as we get some of those first article and lower margin jobs that we bid on in the defense industry, as we get those out of our pipeline, we'll start to realize, a better mix of higher margin products. We're also going to have a higher mix of higher margin products because of some of the things Matt talked about, such as our next gen nozzle, where we can charge a premium because of our technology, and as well as some of the other R&D projects that we're in the middle of now, that will allow us to charge higher prices and essentially then extract higher margins. And then finally, and maybe most importantly, it's going to come through better execution. So we're investing in things such as automated welding equipment, which is going to improve our efficiencies. And, the early signs on that is that we're getting 8 to 10x more and better efficiency than doing those manually through this automated welding equipment. We're also investing in our operations and things such as a new ERP system at our Batavia facility, which is scheduled to go live mid this year. And just really following the mantra of getting better every day. So coming in, improving our processes and improving our operations to thus gradually improve our margins over time. So it really is a multifaceted approach that we could take advantage of.
Thank you, Chris. Let's move to orders and backlog. Your most recent quarter showed a book-to-bill ratio of 0.5 with a backlog about 300, almost 400 million. Could you discuss the trends that you're seeing from your customers' decision-making and expectations of backlog conversion to revenue in the quarters going forward?
Sure. So first off, let me just say that, the third quarter, our third fiscal quarter, which ended in December, was consistent with our expectations, including the orders. As you know, given the nature of our business, our contracts tend to be larger in size, so our order size is very lumpy. Our defense contracts can range anywhere from $10 million up to $100 million plus. So obviously, when those hit, there's a extreme variability in our book-to-bill ratio. Over the last 3 years, our book-to-bill ratio was as low as 0.5 as in the recent quarter to as high as 2.4. And the team has done a really excellent job over the last 3 years growing our backlog. 3 years ago, we had a book-to-bill ratio of 1.2. The year after that, we had a book-to-bill ratio of 1.3. Last year, we had a book-to-bill ratio of 1.4. And even though our book-to-bill ratio in the third quarter was 0.5, year to date, it's 1. So we don't have any concerns. And on the current quarter call, we did reiterate that our order pipeline remains robust. So we're not concerned about it at all. As far as, the conversion of that backlog, we've come out and said that we expect 45 to 50% of our current backlog to convert to revenue in the next year. So for fiscal year 26, which will start in April, we already have approximately $180 million in backlog to fund that. So bottom line, our orders are as expected. The backlog provides us tremendous visibility and stability to our business. So, we're not concerned.
Thank you, Chris. And at this time, I'd like to open the floor up to the audience if any questions. Okay, if not, we can move along. Let's go to a capital allocation. You've got cash on hand, no debt. Your CapEx guidance is around 15 to 20 million for 25. How do you prioritize your capital allocation between growth, M&A, and then shareholder returns?
Sure. So as Dan and Matt have been talking about, we have an abundance of 20% plus ROI opportunities. So we're always going to favor organic growth first and foremost, as that's the least risky and it's the most profitable for us. Prior to being acquired by Graham, Barber-Nichols was capital constrained, and Graham was in the middle of a cyclical downturn. So they really didn't have the capital to grow. Now with our return to profitability and now that we've shored up our balance sheet, we have plenty of capital to fund this organic growth. We've come out and publicly said that we want to spend 7 to 10% of revenue annually on CapEx. And again, these are all on opportunities that have a greater than 20% ROI. Just to give you a few examples, a year ago, we announced that, we were building a new and expanding our defense business in Batavia with a new 30,000 square foot facility, $18 million facility for our, to expand our defense operations and to speed up our throughput. Last quarter, we also announced the launch and that we will be constructing a new cryogenic testing facility in Florida. So these are, and I already mentioned previously, the automated welding equipment. So this is just some of the opportunities that we see that are going to generate this future organic growth. In addition to the organic growth opportunities, we also do have an M&A leg to our growth strategy. The first slide in the supplements to this presentation, we've come out and publicly given, what we're looking for as far as M&A targets. And maybe Matt, I'll leave that to you and Dan to talk a little bit about our M&A pipeline.
Yeah, and I'll just be quite brief because I know we're running out of time. But with that being said, our focus there is not looking for businesses that are just up for sale. We're being very opportunistic because we have a full organic pipeline. And with that being said, we're looking for businesses that fit into the portfolio that we've established. And so Dan and I are actually actively reaching out to businesses that we believe would be good fits and having traction in those discussions. And so we're in the early phases, but excited for what could come from it. With that being said, we're looking from the 20 to $80 million range, nothing that's, another, total transformation, but a good addition as a third leg to the stool. So with that being said, I'd say that, we're in the early phases and look forward to it progressing.
Thank you, Matt, for that, and Dan and Chris. We're sort of running out of time. Great job. We hope to have you here this summer at our aerospace conference in September, and hope to have you back next year. Again, great job and a great year, and looking forward to more.
Thanks, Tony.
Thanks.
Thank you so much.
This podcast is an excerpt from Gabelli Fund's 35th Annual Pump, Valve and Water Systems Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of December 31st, 2024, affiliates of GAMCO Investors Incorporated beneficially own 5.1% of Gorman Rep, 3.3% of Graham Corp, 2.65% of Enpro, 2.44% of Watts Water Technologies, 2.41% of Mueller Water Products, 2.05% of Flowserve Corporation, and less than 1% of all other companies mentioned. One of our affiliates serves as an investment advisor to Crane Company or an affiliated entity and has received compensation within the past 12 months for these non-investment banking securities-related services. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914, 921-5100 fax, 914-921-5118 info@gabelli.com.